everyone, I'm Suzanne Docobo, your favorite realtor and CPA. I'm here today with our lending expert, Joey Rivero, owner of Clear Choice Lending Group. And today we're gonna go through all the things that you need to know about your lending process. And many of these things are things that nobody tells you and buyers don't know and some agents don't know. Everyone knows that real estate is a great wealth building tool, but what they don't know is how to leverage their financing. So Joey here is gonna help us today to understand how to better do that.
Thank you so much for having me on. I'm really excited to talk about these things with you guys and help everybody get informed.
We are so excited to have Joey here, so let's dive right into it. One of the first questions we get is, how much money do I need to put down on a loan?
You know, that's such a big misconception. Everybody always hears 20% down. That's like what we're taught when we hear about real estate and purchasing a home. And the reality is you don't need 20% down. First-time home buyers can buy a property for themselves with as little as 3% down. And a lot of people don't realize that. And a lot of people say, well, I want to save to have a bigger down payment, but then they don't realize that the property will appreciate and you'll make up for that difference. It's better to start owning today than to wait around till you can save 20% down.
So there's different types of loans. Obviously, some people are buying primary residences, some are second homes, some are investment homes. So how much would be the minimum amount that I'd have to put down for each one of those categories?
That's a great question. So a vacation home, a lot of people don't realize that you can buy a second home with as little as 10% down. And an investment property, which is where you're gonna basically rent it out year round, you can buy with as little as 15% down.
So one of the questions that we get is, what is the difference between a second home and an investment property?
Yeah, I get that a lot. That's a great question. So second home, basically your intent is to use it as a second home. You're not gonna have any long-term leases on. You're gonna use it at least 15 days or more out of the year. Whereas an investment property, you basically have the intent of using it as an investment property and not using it for yourself.
That's really, really good information so that people can understand which loan they should be applying for when they apply.
Absolutely.
I get other questions like, what is a QM loan versus what is a non-QM loan? So I think that that is qualifying mortgage versus non-qualifying mortgage. So what would that mean to a borrower?
Yeah, so qualified mortgage you are correct. And qualified mortgage means that you can prove the ability to repay. So traditional financing, you make your loan application, you can show us your pay stubs, your W-2s, and you can show the ability to repay the mortgage. Non-qualified mortgages, different avenues. For self-employed people, they have bank statement loans. We have programs that basically traditionally will finance you off of your rent schedules and how much the properties can rent for, assets, different program types that are just non-traditional.
So what does that mean for a borrower? It means that don't assume just because you aren't approved for a traditional loan or qualifying mortgage that there aren't other financing alternatives out there, such as what Joey just mentioned, bank statement loans, DSCR loans. There's also hard money loans and private money lending. So there's other options, and you want to make sure you have a lender that can reach into all these different pockets and find something that works best for you.
Yeah, there is so many options out there, and a lot of people don't realize that. And we really will look and tailor it to you.
So one of the most popular loans that I hear about from our investment clients is DSCR loans. Most people aren't even familiar with these loans. Can you tell us a little bit about how they work?
Yeah, they are the easiest loan out there to get because, believe it or not, the way it's qualified is based on the rent roll that the property brings in versus the debt of the property. And you don't have to always match one-to-one. You can actually sometimes have even less. So the DSCR loan is such an easy loan to get for an investor. It makes it very clean, very easy, no paperwork, no hassle.
Yeah, so you're not showing your W-2s, you're not showing your income. It's based on the income of the property. For a DSCR loan, how much money would I have to put down?
So the minimum down payment, that's a great question. 20% down is what the DSCR loans are typically looking for.
Okay, gotcha. So is there any PMI on those type of loans?
No, because those are non-traditional, non-QM loans, so PMI is not on them.
And you're putting 20% down, so therefore PMI shouldn't apply in that scenario.
Correct.
So other types of loans that we have out there besides DSCR, is DSCR the same as a bank statement loan?
No, traditionally a DSCR loan, like I said, has no documentation requirements. Where a bank statement loan, we basically look at your bank statements for the last 12 months and kind of use your income averages from there. So it is a little bit more of a headache, a little more paperwork inclusive, where a DSCR loan is straightforward.
What are the scenarios where I wouldn't qualify for a DSCR loan or a bank statement loan? Is there certain credit requirements or other requirements?
Yeah, so DSCR loans go down all the way down to a 640 credit score, which is really great. Bank statement loans are the same thing. The reason why people would choose a bank statement over a DSCR is you can do a bank statement loan with as little as 10% down.
Wow, that's amazing.
Yeah.
I don't know if many people knew that. So Here, you heard it here first. So speaking of DSCR loans, I am a CPA dork, so I know that means debt service coverage ratio, which most people are not going to care about that. But for DSCR loans, what they are going to care about is what type of interest rates can we get for those as opposed to a QM type of loan?
Yeah, that's a great question. So typically the spread is about a point to a point and a half difference from your traditional financing, which is way stronger than what you would get in private money lending, right? Because private money lending, you see a lot bigger of a spread.
Absolutely, and that's a great segue into another type of loan that is obviously a non-QM loan, which is private money lending and also hard money lending. So those type of loans, if you don't qualify for a traditional or a DSCR or bank statement, then these are also other types of loans that we can dive into. So can you tell us a little bit about what that looks like?
Yeah, so private money lending is great because it's an option to close quickly. You're looking at it strong. They look at basically your down payment. They're leveraging how much loan to value they're using. So the bigger the down payment, the easier it is for them to close. And typically we're seeing hard money loans closing in a week or two.
And private money loans and hard money loans typically have higher interest rates than your QMs and your non-QM type loans. So generally, those are the type of loans that you might want to refinance out of later. But it's better to get the property. So what they say is marry the house, date the rate, right? So if we were going to refi out of those type of loans later, what would that look like?
Yeah, so typically people use that as a bridge, right? You've got a great opportunity in front of you. You need to close quickly. You may not be prepared right now to buy the property. Well, what we do is we get you this hard money loan and we also talk about the preparation. So that 6 months down the road, we can start looking into the refinance options to get you out of that program.
Gotcha. Is there generally any prepayment penalties for those type of loans?
So their hard money loans do normally have a 1 year penalty, sometimes a 2 year penalty, but that's also just negotiating as part of your terms.
Absolutely. So you can negotiate that if you know that you're going to pay it off sooner, if you're not going to hold it for a year or anything like that.
And you know a lot about negotiating. So.
Yes. So do you. So now we're going to get into something that most people just don't know. And that's the fact that Fannie Mae and Freddie Mac investment loans that you can close in your personal name and you are now allowed to deed it into an LLC with the same ownership right after closing. And that is for liability purposes and protection. It's something that investors have been doing for years and years and years, but now it's actually allowed.
And this is when our CPA over here helps you get protected, right? June of 2016, that was changed. And it amazes me today how many people don't know that you can do that. Prior to 2016, you were not allowed to do that, and they would ask for you to pay, they would exercise their paid in full demand if you moved the deed from your personal name into an LLC or a corporation. Where now you can actually move it and be okay and protect yourself.
Right, so basically it doesn't trigger the due on sale clause, which is the thing that everybody was scared of, and many investors would do it anyway and take the risk, but now they realize as long as it has the same ownership, that you can deed it into your LLC post-close. So it's just a really important thing for liability protection, for asset protection, and all kinds of things. So if you didn't know, now you know. So one of the questions that I get a lot is about PMI. Private mortgage insurance is required when you don't put 20% down on a loan. So the question is PMI permanent?
That's a great question, and we get that all the time. So FHA, unfortunately right now, it is permanent. So the only way to remove it off of that would be to refinance. But on a conventional home loan, it actually isn't permanent. As your property appreciates and you pay down your mortgage balance, you can actually request the bank to ask them to cancel your PMI contract once you hit that 80% marker. So the way properties are appreciating at 4% and 5% and 6% annually, you can be out of PMI in as little as 3 years.
Well, what I heard you say that's very important is you can request. So this isn't something that banks are typically going to do for you. So
they're not going out there trying to save you money, I can tell you that.
Right. So if you put less than 20% down and you have the PMI in your mortgage, you're going to want to watch the appreciation of the value of your home.
Absolutely.
So you can request it to be abated by your lender at a certain point in time. And FHA loans, as you said, it doesn't ever go away.
It does not.
But you could refinance.
You could always refinance that FHA loan and go to a conventional mortgage. And even if you don't have that 20% equity, which is another thing, people think that you have to stay in FHA until you can get to the 20% equity mark. Not the case at all. As long as you have some equity, as little as 5% equity, we can get you into a refinance. And then you can start using the lower PMI from the conventional loan versus the FHA higher PMI rates.
And obviously, we'll have to have a certain debt to income ratio that meets the conventional guidelines.
Correct.
That's the only other caveat that you have to think about.
That's the only other caveat. But it's an easy question to figure out.
That's great information. So we're going to go into the next question that we get all the time. What is the difference between a pre-qualification and a pre-approval? Now, before we have Joey answer that, I want to say that as an agent, if there's an offer submitted, I require a pre-approval. And Joey's going to explain what the difference is now, and you'll understand why we require a pre-approval and not just a pre-qualification when you submit an offer.
Yeah, no, that's a great question, and we get that all the time. Pre-qualification and pre-approval. What is the big difference? Well, a pre-approval, we're actually digging deep. So that when you're actually looking to buy the house, you're making an offer and you know that everything is 100% validated. We've checked over your income documentation, we reviewed all your assets for your down payment, and there's not gonna be any hiccups. You basically have to plug and play a property and we can close you in 10 days.
So what would a pre-qualification entail?
Yeah, so a lot of traditional lending companies or banks or credit institutions, they'll basically take your application over the phone, talk about your income documentation. They won't collect it. They'll ask you how much you make, and they'll do everything based on what you state to them. Nothing's verified, and all they're doing is just a quick look at your credit, and they give you the green light. What happens is, once you turn in your documentation, there could be a hiccup, and it could stop you or prevent you from buying, and even endangering your deposit.
Right. And also it's, there's a lot of fraud out there, and it's not to say that everybody with a pre-qualification has fraud. However, it is important to note that people just forget things. They forget that they might have a car loan. They forget to turn something else in. They just don't know. And as a lender, Joey has to look at the entire picture, and if you forget to tell them something over the phone and it gets caught later, you may not be approved. So from an agent perspective, we just can't accept any offers without a true pre-approval, which means the lender has vetted, got documents, got the information, verified the income, and that they actually qualify for the loan. All right, so if somebody is pre-approved and they put an offer on a property, how quickly can your company close?
Oh, 10 days. That's one thing that's beautiful with us is what we do is we get all your documentation up front, keep it all up to date and current, especially up until when you're making that offer, so that we can have you go right into underwriting the minute the offer gets accepted.
Is that 10 calendar days or 10 business days?
We can get you clear to close in 10 calendar days.
Wow, that's pretty amazing. A lot of lenders cannot do that, so that's just really amazing. That's another reason you need a really great lender. Is there any exceptions to that rule? Because there's different loan types. Are there any loan types that take a little longer to close?
So some of the non-QM loans, like we talked about earlier, do take a little bit longer. So traditionally, the non-QM stuff takes about 15 days.
And obviously, this is also subject to you as a buyer actually providing all your documentation to the lender. So,
participation is definitely key.
right, you can work some magic, but you definitely need participation.
Participation is key for sure.
For sure. There's a lot of misconceptions about what kind of income you need, whether you have W-2 versus self-employed, and some people just think they won't qualify for certain reasons. So what do you really need in order to qualify? Let's start with a W-2 type employee.
That's a great question, and I'm going to tell you that lending really looks back. We do a 2-year look back. I always tell people the magic numbers too for us, because we look back at your income and your job history for the last 2 years. We look at where you've lived for the last 2 years, and that's really where we really traditionally look. So as far as like documentation goes, we look back at your last 2 years W-2s, we look back at your last 2 pay stubs, right? And a lot of times people always say to me, well, I just got a raise. We're not going to take an average. We're going to always account for the most current situation. So that's why it's also important when you're doing your pre-approval to provide the most recent and accurate information.
Oh, that's very interesting. And also, some people are self-employed,
Yeah.
so they don't have W-2s. It's a little more complicated. How does it work for self-employed individuals?
So self-employed individuals, you do have to file your taxes, and we do a 2-year look back as well. Now, you could have just become self-employed for 1 year, and you were traditionally in the same line of work, and we can help you in that way as well. But typically, we do the 2-year look back, and you've got to have your taxes filed as a self-employed person for at least 1 year.
So if you were, let's say, working at a W-2 job in the same career line, and then you go out and become self-employed, so you've only been self-employed maybe for 1 year, not 2 years, that would be helpful?
That would be helpful, absolutely.
Okay, that's great, because a lot of people think that they have to have 2 years of the self-employment history and that the W-2 doesn't even matter once they become self-employed. So I think that's a big misconception that people don't understand.
Yeah, a lot of it's a rumor mill, right? Everybody hears from their friends and family, and they don't go to the professionals.
Right. Another thing is, what if I start a new job? I'm brand new and I don't know exactly, or I don't have a history in that profession.
A lot of people think that if you start a new job, you can't qualify for a mortgage. That's not the case. We look back at a 2-year work history. So as long as you've been working for 2 years and working and be able to provide your income, we can start a new job. You're allowed to change careers. You can go from being, a plumber to becoming a mechanic, right? We're just going to validate your income and make sure you're still working and gaining a gainful income.
All right, so basically you just want to make sure that you're employable, you're employed, and you're going to be consistently making a certain amount of money.
Correct.
And so that's actually really, really helpful. What about people or that have student loan debt, for example, and so they're concerned? I get that question a lot. We have so many student loans. Am I going to qualify for a mortgage? So how is that looked at from a lending perspective?
Yeah, there's so many different ways it's looked at and so many different programs. One of the coolest things about lending is we have all those options, right? So typically when you have student loans, we look at deferments if you're on deferments. If you have income-based repayment, which a lot of people do, we can use your income-based repayment reduced amount. If you have Fannie and Freddie Mac, they use different calculations where they look at a 0.5% of your total balance versus 1%. So there's a lot of different options to make that student loan debt look a lot less of what it is to help you get qualified. It should never hold you back from buying a property.
That's super interesting. I think a lot of people really don't know that. I mean, I know this is going a little bit out of order, but I also wanted to mention something that I think a lot of people don't know for the self-employed individuals. There are certain add backs from your Schedule C if you are a contractor. I happen to know this because I do taxes, but if you do certain types of things like mileage deduction for automobiles, depreciation. So tell us how that would affect you if you're self-employed.
So a lot of times people, when you're self-employed, we review the tax returns and we basically do a full out income calculation up front based on what underwriters look at so that we know exactly what to look for. So when you have depreciation, you can add that back towards your income. When you have mileage, you can have a certain rate. I think the mileage rate now is like 74 cents a mile for business mileage. You can add that back into your income. A lot of people don't know those write-offs can come back to help improve your annual income to help you qualify for a mortgage.
Absolutely. So obviously, those deductions being added back just gives you a higher income level, which helps your debt to income ratio and can help you qualify where you otherwise don't think you qualify. So
There's also another big one too, one-time losses. A lot of times people don't realize, let's say you own a business and you had a major loss in the business and it was a one-time thing, like a big piece of machinery had to get replaced. That's a one-time loss. We're able to add that back because you're not buying that big piece of machinery every single year. It was only a one-time loss.
Gotcha. And that's another thing, like a 179 expense deduction that the people are taking like 1 year, you know, and it's not really a loss. It's a capital, a capital improvement or equipment that they purchased. So
that's why it's super important to turn in all your documentation and go with the full pre-approval process versus getting pre-qualified.
Right. So it's really important. I mean, if you're not sure, that's why we have professionals here like Joey. It really just takes a simple phone call and submit your documentation and, and also I know that you don't always pull the credit right away if that's a concern.
We actually hate pulling credit. It costs like $135 every time we have to pull somebody's credit. We don't like to pull credit.
Right.
So we have different tools and technology so we don't have to actually hit your credit. You don't have to worry about your credit score being. So we can look at it and give you a very good idea. And then when it's ready, hey, we're ready to make a move, then we'll actually pull your credit to make sure your approval is final and done.
And that doesn't mean that Joey's not going to ask you what your credit is because he does need to know that in terms of, whatever loan options you're going to have. He's going to rely on you. And so your credit will be pulled at some point. But we don't have to do that right away. And, he can just based on the data that you give him and get you is it a pre-approval yet till you pull credit? But
no, it's not a pre-approval. It'd be more of a pre-qualification.
Okay.
It'd be a roadmap to get you approved.
It's like in between a pre-qual and a pre-approval, I guess. But you can get that information just by sending the documentation and figuring out. Yeah, have it review and know what your loan options are. So there's so many different loan options out there. You don't have to have a qualifying mortgage option. There's so many other things. There's creative financing. And this is why you really need a team of experts. I always say, I'm only as good as my team. We're extremely successful in the real estate industry, but we rely on our lender, our title company, our inspectors, and all of our vendors that, to pull it together, to have a great team to make sure that the transaction goes smoothly. Yeah. So I want to just say thank you to Joey because you have made many of our transactions go extremely smoothly.
You're welcome.
And been extremely creative when we ran into hiccups here and there and been able to navigate that and basically be a chameleon and figure out a way to make it work for our buyers. So we really, really, really appreciate you and we're grateful to have you on our team.
And I'm so thankful to work with you guys. And I think we just want to do the common goal is get you the best experience possible and get you closed.
Absolutely. So if you want more information, Joey's information, we'll post it below. Subscribe to our channel. We're going to keep the good content coming. And as always, reach out to us. If you have any questions, we're always here to help.
Thank you so much.
Thank you so much.
I enjoyed being here today.
Thank you.